drop.
All right, guys, what is going on? What is good? What is good? Welcome to the live stream. Welcome. We are starting a new series today. Chat is open. And I'll give this a minute for people to hop on. We'll give it a minute. And I was going to leave the... I don't know what button I just pressed. I don't know what that does. OBS problems. So, hopefully you guys can still see in here. Can you guys drop a 1 in the chat real quick if you guys can see and hear? The trim should be different today, right? Hopefully that's something easy and obvious, right? Did you guys have a good weekend? Okay, my chat is now being weird. Okay. It's fine. It's fine. Did you guys have a good weekend? Weekend was grand. I don't know why it's adding like a Chinese symbol right before your text. That's so weird to me. How was my weekend? Phenomenal. Phenomenal. It's going to be a good week. It's going to be a lovely week. Weekend was too short. Nah. Nah. We don't want weekends. We want weekdays, baby, because we want to trade. Can't trade on the weekends. Well, at least in the futures market. But, again, we'll give it a few more minutes just to make sure everybody can hop on. Today's going to be episode 1 of Core Technical Analysis Concepts, beginning a new series today. It's been a long time since we've gone over some of the basics. We have a lot of new people here now, so I feel like we got to do a refresher. You know what I mean? And who knows, maybe you will learn something new for the people who have been here for a while. So let's do our intro and then we'll do our rundown. What's good? 2020, Mason, Darth, Quinn, Scott, Julius, Willow, Dan, Jorks, Julius, Mason. I said Mason already. Welcome back. Lewis, Nicholas, Lucas, H, and Mark. Good morning. Kraft, Laurent, welcome. All right, so two things for you today. The first one is we're going to go over inefficiency, okay? The various types of inefficiencies. The second thing, don't let me forget this, chat. The second thing I want to close with today is going to be how to read the, oh, I lost it. How to read the Meditations of Marcus Aurelius. So I did drop that PDF already in our Discord. You guys are welcome to, it's a one-pager. It's real simple, real easy. But I do want to go over that a little bit later. Okay, so don't forget that our book of the month for April of 2026 is the Meditations of Marcus Aurelius. This is a really awesome version. This is the modern library version. And I also said that you can do the Robin Waterfield version, the annotated edition, which is a lot more text, but it's more in depth. So you actually understand who some of the characters are. This, is like 1900, 1800 years old. So you're not going to understand who those names are without annotations. So that will be for later. All right. So you guys ready to get started? Drop a 1 if you guys are ready. Core Technical Analysis Concepts, Episode 1, Inefficiency. Episode 1, Inefficiency. Honestly, I shouldn't have started with inefficiency because this is some advanced stuff, but it's okay. It is okay. I trust we are all, smart enough to understand. I mean, it's not complicated. It's just a lot. Okay? Yep, Eric, you're late and you're banned and blocked. You're bland. I could have a joke for that, but I'm going to move on. All right, so we are getting ready, I think, to trade to the 250s. And I was hoping we could do that in our intro. I've already muted the sound, though, so you won't be able to hear the alert go off if it does end up doing that. But, of course, yes, I will talk about, current price action for the day. But the main core concept today is going to be inefficiencies. Okay, thank you, Willow. I appreciate that. You guys can scan the QR code, too. If you're outside the U.S., you can scan that QR code and open up a demo account or whatever at stoicfx.com. You know what I'm saying? You know what I'm saying? All right. So, an inefficiency, okay? The markets are not entirely efficient, okay? They leave behind imbalances. They leave behind gaps. And both of those, right? The imbalance and the gap are both a type of inefficiency. Okay, so don't get that confused. Like, if I were to basically make the notes for you, I'm not going to do that, but if I were going to do that, I would say, right, episode 1, inefficiency. I think that's how you spell it. I'm not sure. But I would say you have the imbalance and you have the gap. Okay? Those are some of your main things. Oh, the date and the time? Oh, yeah, that's not good. Can you see it now? You should be able to see the... Oh, you're talking about up here. Ooh, yeah, we're going to have to fix that. We will have to fix that. This is the Nasdaq on a 1-minute chart. Okay? But yeah, I'll have to fix that later. Thank you for bringing that up, Jorks. Bang! There's Sunday's gap, baby. Ooh, who could have predicted that? Let me launch that tweet real quick. Let me launch that tweet real quick. Because they say that price is unpredictable, right? Oof. Look at that. Okay. Now that here is just a follow-up with what we were talking about, what I was talking about earlier. How we could take out Friday's lows and maybe reach for Sunday's gap. That was just pure speculation. And I'll talk about this a little bit. And then we leave behind the highs and then we still come down for that Sunday's gap. So I just think the way they did it, I don't really care for the way we did that because they brought it up one more time to leave behind these highs and then dragged it. So I don't usually care for that, but You know, whatever. Anyway, back to the main point. Inefficiency. What do you think an inefficiency is? What do you think an inefficiency is? Like, here's one right here. We'll start with that. We'll start with that. The imbalance, okay? The imbalance is a 3-candle formation. Okay? Now, in this case, we would be looking at a bearish imbalance. One-sided price delivery or no price delivery at all. So Jorks, no price delivery at all is a gap. I'll go over that in a minute. One-sided price delivery, that's what a imbalance is. Okay? Well, in this case, this is a bearish imbalance. Okay, I'm not gonna sit here and draw like every single wick because we would be here for probably a few hours, and I'm not gonna make you sit through a 3-hour video. All right, so we have a candle lower here, candle lower. This candle opens to trade higher and then rolls lower. So the imbalance, which again is one of the inefficiencies, okay, that's its classification. The imbalance here would be from the first candle's low to the third candle's high. Okay? Drop a 1 in the chat if you guys are with me so far. The first candle's low. Okay? That's the first candle. That middle candle is the second one. And the last candle is the third one. Okay? We're not counting candles. I'm labeling this as a demonstration for you. The first candle, that middle candle, and the third candle. First candle's low, wick. Third candle's high, wick. That, okay, this box here, or what I used to do a lot was just like the horizontal array, something like that. First candle's low, third candle's high. So now in this case, my drawing levels here are 365.5 up to 375.25. So that's about a 10-point range for NQ of inefficiency. So what that means is, Jorks, we have one-sided price delivery. We had sell-side price delivery. Okay? And we lack buy-side price delivery. That's why it's one-sided. Okay? So that's why I said in here, okay, that is candle 1. That is candle 2. And this is candle 3. See how that works? Now, we don't really have one over here. Okay? Now, that's your normal imbalance. However, there is an exception to the imbalance when we have a gap like that. Okay? You see how, and I'll really zoom in to make sure you guys can see it. You guys see this gap here? Drop a 2. It's this one right here. That candle's close to this candle's open. You see that space right there? You see that little bit of space between the two. And if you're ever in doubt, what's really cool too is you can click on the candle and hold it. Your mouse click and hold it, and it will bring up the open, high, low, close. So we don't have to look up at the top left. I know it's cut off. But instead of looking at the top left for that information, okay, and when you move to other candles, it will paste that information. So you can see this candle's close is 355 and a quarter, or 3/4, sorry. And this candle's open is 355 and a quarter. So there's like a 2-tick gap between that candle's close and this candle's open. So the exception for this imbalance, okay, it is no longer the first candle's low when there is a gap. What we have to do now is we have to include that gap as part of the imbalance. All right. So it usually won't make that much of a difference, but if you want precision, okay, you need to know this. So if you have an imbalance and there's a gap as part of it, we include both. All right, so you can see in this example, price traded up and into it to go lower. All right, now that's not all. That's not all. I'll give you some more juice here. We talked about the imbalance, at least the bearish one. I talked about how when we have an imbalance, if there is a gap, we want to include that as part of the imbalance. Now, this is also a good segue into the 50% level. Now, all of the concepts that you know of, okay, they can be cut in half. All right, so on TradingView, there's a checkbox in here that says middle line. When you don't have it, there's no midline. When you check it like that, that pulls this up. I leave mine gray because I have other colors for other boxes and I want to keep it all the same. So my midline is a faint gray. So that's important because when we cut concepts in half, right? Every concept that you know of has a premium and a discount to it. Simply put, premium is upper half, discount is lower half, right? Again, this is not complicated stuff here. The upper half, right? And we may not necessarily want the midline on that. I mean, you could do quarter levels, but I don't think you need it. But the 50% and above it is the premium end of that concept. And the lower half is considered the discount end. Okay. There's a lot of overlapping here because of everything, but I think you get the gist of it. Upper half, lower half. All right. And guys, again, if you're not taking notes on this, you're missing out. We talked about the imbalance. We talked about the exception. When there's a gap, you include that. We talked about the 50% level because we have the upper end and the lower end. If you are bearish in this example, if you are bearish, what you do not want to see is the candle closures in the upper half. You don't want to see the candle closures close in the upper half. The market's allowed to, let's say, wick up there. Okay, and for sake of argument, we can just draw that on here. Pretend like it's a wick. The market can trade to the upper half. The upper end. It could even, go all the way to the actual gap and close off of it. It's allowed to do that. You don't want to see that, but it's allowed to. But what's more important than the wicks here is the candle closures. If the candle bodies are respecting the 50% level, that is what you want to see. That means we are bearish. Okay? especially if there's something on a higher time frame that is calling for lower pricing. Okay, kind of like I did on Twitter. Sorry, I had to throw that in there. I can't stop myself. So, what do we get? Lower pricing. And, well, that didn't really trade into anything that I wanted. And again, we rolled over into Sunday's gap. And that Sunday's gap was something that I called for back at 9:30. See how that works? So I may not always, let's say, get it right on that first leg lower. Market came back for buy stops. I didn't put that tweet on here. I might go over that later if you want. But we came back, left highs, still respected this imbalance up here. Okay, I'll zoom in on that too, just to prove my point further. Here's another imbalance, chat. This is a 5-minute NQ, so we've zoomed out a little bit. If I have you lost, just let me know. Say, hey, John, slow down or go back. Just let me know, all right? But same thing, imbalance, but look. See this gap right here? So I am including that gap in this measurement. Okay, so the low end of this inefficiency is that right there. See that? 23,423 and 3/4 up to that. That is a 5-minute inefficiency. Now, what did I just tell you on the 1-minute time frame? If you are bearish, you do not want to see, if the market is heavy, you do not want to see candle closures in the upper half. And ideally, you don't want to see wicks in the upper half. Now watch this. We're still on a 5-minute chart. You see that right here? Do we ever get to the upper half? Nope. Now put that together. Hold on, John. This is beginner stuff, and you're already telling me to put all this together. Well, yeah. I can't help myself. You gotta learn this stuff. Look at it. Can't get in the upper half. Imbalance, can't get in the upper half. Stays bearish. See that? That's reading price. Now, obviously, this is just one concept, and there's a lot more to it than this. But so far, that is what we covered. How imbalances are measured, how you can measure them when there is a gap as part of it. We talked about the 50% level. And if you are bearish, you don't want to see candle closures in the upper half. You want to see price ideally stay in the lower end, or the bodies stay in the lower end. Otherwise, it may not be bearish anymore. And it may instead become, drum roll, an inversion. Okay? Now, what the hell's an inversion? Oh, sorry, I'm not supposed to be cussing. What the heck is an inversion? All right, we'll take a look. Take a look. An inversion is when you have a concept and it doesn't get respected, or maybe it gets respected initially but then gets ripped through. So watch this. We already know what an imbalance is, right? We went over that. It's 3 candles. First candle's low, third candle's high. Right? I agree, Willow. I agree. So you see this right here? Now, by definition, by the definition that I just gave you, that is an imbalance. Yes, it is. But I will tell you that when you incorporate stuff like levels of liquidity, which we're not going to go over today very much, but when you incorporate stuff like that, after, you know, when price goes lower and lower and lower and lower and lower and lower and lower for a long time, okay? I know, Cameron. At a certain point, it's not going to stay bearish, okay? The markets do not trade in one direction forever. They don't consolidate forever. Eventually, you'll learn about the 4 phases of price. I think that's episode 4, so I won't get ahead of myself here. But you'll learn about the phases of price and consolidation, expansion, retracement, reversal. You'll learn that stuff. When you anticipate a reversal, or if you are watching to see if price is forming a reversal, then what you want to see is a failure of that imbalance. So what do I mean by failure? What the teachers thought I'd be when I was a kid. A failure. All right. This imbalance right here, you can clearly see it, 9:46. I'm Central Time, by the way. 9:46, this candle obliterates that, right? It shows no response whatsoever. I mean, it just runs that like a red light. You know what I'm saying? It just goes right through it like it's not even there. So what ends up happening here, okay, look at that. It was not respected to go lower. Zen, this is public. This is public. Okay. Now, I should hold back a few things, but I'm giving it all to you. I'm giving it all to you. Okay. That imbalance, not bearish. So what does it become instead? Look at this. Price response. Price trades down into that a couple more times, but look at where the bodies are. You see how that works? That may be slightly in the bottom half, but there's also like another imbalance over here. So you have to level with me for a second. But let's take this off, matter of fact. Let's take that off. We're not going to be, blending concepts together right now. That was not bearish. So it becomes what? Bullish. See that? Shift in a steady delivery. Bang. Continuation. Shift in a steady delivery. If you're new, you probably don't know what that is, but that's not for this episode. But drop a 3 if you in the chat if you guys are with me so far. Imbalance, right? On the way lower, but it showed absolutely zero interest whatsoever to be bearish. It gets blasted through. And instead, if it's not a bearish imbalance and we are going to see higher pricing, then it's going to become an inversion, which means it's opposite of what it's supposed to be. So it's not bearish, it's bullish. And you can tell the bodies all in here are respecting that. And then we get what? Higher pricing. We get an attack on trailing stops. This is a 1 minute on NQ. Would that first wick be initially considered an immediate rebalance? I cannot tell which candle you're referring to. I don't think so. That to me is an immediate rebalance, but that was our run below Friday's low right there. See how perfect that is? Nailed it. Interesting. But nobody can ever time the market, right? New stream frame, not possible. I know, I'll have it fixed by tomorrow, chat. Don't worry about it. All right, great questions, then. There's multiple imbalances everywhere. What time frames would you say imbalance the most? Okay. So I'm trying to avoid getting into frameworks like the market maker models and all that stuff, because that's for much later. What I will tell you is, though, when we have I need to go out to the 5 minute for a second. And at this point, with so many tweets and markups on here, we just have so much going on. But don't be afraid to get down and dirty. Okay, don't be afraid to get down and dirty. Watch this. What do you do when you have two? Okay, it took me Look, it would be embarrassing if I told you how long it took me to learn this. Okay? It would be embarrassing. So I'm not going to tell you. It's a long ass time. What do you do when you have two? Because you'll come across this. Because that is an imbalance, and that is an imbalance as well. As soon as 11:05 closes and 11:10 starts, that becomes an imbalance. So when you have two, what do? Because that will come up. Now it's kind of an advanced thing here, but I know some of you are going to study this stuff and then you'll come across that and not know. But that's the wonderful thing about being a teacher and about knowing all this kind of stuff is I know the questions that you're going to have before you even come up with them. That's why I love this stuff, baby. That's why I love this stuff. We're not going over macros today either. Let me go over that later, but not for this video. When you have two imbalances in the same direction, basically, because that's what we're looking at here. We have an imbalance on the way lower and then another imbalance on the way lower. Jay said split risk. That is one possibility. You could have, let's say you could trade the lower one with half a risk, half your normal risk, and then maybe put your other order at the higher one. Sure, that is one solution or option. The other option, whenever you have two imbalances, you take, in this case, since they're bearish, you would take the lower one with the stop based on the higher one. Did you guys catch that? When you have two, you can take the lower one with a stop at the second one. Drop a 4 if you guys understand. I got to take a swig. There's nothing like that Icelandic glacial chat. I'm telling you. I had to get a t-shirt. I don't know if they have that. Okay. So, what have we covered so far? The imbalance, the inversion, 50%, the imbalance with the gap included, and the imbalance when you have two. Now, there's a couple more things. And this is why I left the tweets on here, because we got a massive run below Sunday's gap. Look at that. Okay. So earlier in the day at 9:30, when I talked about taking Friday regular trading hour lows and maybe reach for Sunday's gap as well, how could I come to that conclusion? How could I make that speculation? I've been doing this a long time. So experience is definitely part of it. But what you have here, and almost every Sunday does this. Almost every single Sunday does this. Not all gaps are created equal. Sometimes they're massive gaps. Sometimes they're small gaps. Very rarely they don't gap at all. Or maybe like a couple points and then I don't use it. I just, the small gaps I don't see a reason to use. Personal preference. But in this case, okay, what took place? Friday's close, 23,254 and a quarter, right? That's Friday's close. Sunday, okay, opens at what? 23,189 and a half. So that right there is Sunday's gap. Here's another cool trick you can do as well. My gaps and my imbalances are usually a gray box, okay? Now, what's really cool, you can go in here, click on the settings of that. You can do your midline if you'd like. But what's really cool too, and I asked them to do this like 6 years ago, but I wasn't who I am today, so they kind of were just like, piss off. What you can do is actually extend that to the right, and no matter where your chart is at, it will move that over for you. See how that works? So that's pretty cool. Now, let me come back to the actual lesson on what a gap is, okay? An imbalance is one-sidedness. Okay, we have an imbalance here on the way up. We have an imbalance here on the way down. Right? That actually becomes an inversion as well. That's pretty solid. See that? Imbalance on the way lower. Saw sensitivity gets traded through. It ain't bearish. So what's it going to become? Bullish. So you see how the bullish inversion stays in the upper half? See that right there? There's a good example for you. Took the midline off of that. See that? See the bodies staying in the upper half if you're bullish. That's solid stuff there. A gap, okay, has neither buy side delivery or sell side delivery. Okay? It doesn't mean there's no buyers and sellers. Orders are everywhere. What it means is price has not offered buy side or sell side delivery. And I use that word specifically, delivery. You'll learn more about that later. Not today. It's lacking both. There's no buy side, there's no sell side. So a lot of the times what you'll see is the market is sensitive to these price levels, to Sunday's gap. And what you have basically here, the 5-minute is a little wild. Actually, go back for a second. You do have wicks here, okay? And you get buy side here, but the problem is that it doesn't have like down candles going through it. Do you guys understand what I'm saying? It's a weird, it's hard to explain, first of all, but it's basically, look, here's our gap, okay? And price, yeah, it stabs into this, sure. But in this case, you see how we have nothing but up candles. That is buy side delivery. That's buy side delivery. But it lacks sell side delivery. It means there are no candles here that print lower and down into it. Okay? Drop a 5 if you understand what I'm saying. But it is doing that now because it's offering sell side delivery into Sunday's gap. Look where price spiked into, and we're seeing some response. It's at the low end of Sunday's gap. That is how you're able to, formulate speculation. We should trade into Sunday's gap at 9:30. We didn't get there on this run. My timing is not always perfect. But yet, later, we do go down in there and offer sell side delivery. Okay? Now, I could tell you why, but I'm going to save that conversation for later. All you need to know is that a gap offers, has offered no buy side and no sell side delivery. When it offers one side of the market, one side meaning buy side price delivery, it lacks sufficient sell side price delivery. That's why it's classified as a inefficiency. Every name has a reason behind it. Okay? It's an inefficient market. So let me say this in closing. for the gap, because we still have the suspension and we still have the reclaimed. I might save the reclaim for another day, but I'll at least go with the suspension today. For a gap, it offers neither buy side or sell side price delivery. An imbalance is one-sided price delivery. It has one side but lacks the other. Okay? An efficient market, or let's say a balanced price range, has both. It has, let's say, like an imbalance on the way lower followed by an imbalance on the way higher. That would then be a balanced price range. We don't really have that here, but textbook definition, there it is. And yes, anywhere in here is great for short covering, whether it be below. Yeah, this, to me, this would be the PM session. So that would be AM session low is good for a partial. I would wait for Sunday's gap personally. And the midpoint of Sunday's gap is also great for covering as well, short covering. Short covering is when you're in a short and you close it. You close a short by technically longing. You buy it back, okay? And you can do that at the midpoint and especially the lower end too, if it gets there, right? Now, obviously, we're looking at past price. This is hindsight here. If I thought we would trade to the low end, I would have told you that. But I didn't say, I just said, hey, I think we should just reach Sunday's gap. And that's as far as I think, as I can confidently say that price is most likely to go there. After that, I don't know. I'm not trying to pick the low of the day, let's say in the PM session, in the AM session. Okay? I'm pretty decent at this stuff, but I'm not that good. All right. So the point is not trying to pick the low or even, let's say, catch the low. The idea is get in sync with price delivery and be able to read price like a book. Imbalances, gaps, inversions are ways to do that. Okay, some of the ways to do that at least. There was, okay, you know what? I'm gonna take everything off now so we can kind of freshen this up a little bit, because I'm getting a headache looking at my own chart. I want you to take a look at this for a minute. Okay. This would usually be better if we had not wicked like this and like this. But earlier I looked at it this way and it's fine. But whenever you have a gap like this, okay, again, this candle closes, the candle after opens above it. So it's a small gap higher. Okay, nothing wrong with that. And you'll see that a lot on, especially like the Dow Jones 1 minute. Ugh, don't look at it. When you have another one, okay, this candle's close is 330 and a quarter, 23,330 and a quarter. Okay, it's that bottom number right there, 330 and a quarter. When I highlight this candle, its open was 23,330.5. So it's a small gap, but it's still there. I'll show you one more time. This candle's close, 23,330.25. This candle's open, 23,330.5. So it's only one tick, but that is still a gap. So now you have a gap right there. And the gap is so small that I don't have the border on my box, and so it's not going to show up there. But whenever you have this, you have a gap up like that, and the next candle gaps up like that, that right there is a suspension block. Okay? body, even though it moves well beyond that, the bodies here, okay, that 10-15 candle closes inside of it. The 10-20 candle opens inside of it, and we get higher pricing. We actually don't make a new high, but this is not the greatest example of what a suspension block is, but I at least wanted to show you. So again, it's just another method of reading price. You don't even have to trade every concept. You may not like suspension blocks. You may not even like inversions. But the point is, if you can analyze this stuff, you can better predict where price is likely to go. We're not looking for perfection. We're looking for probabilities. Not to sound like ChatGPT or anything, but that's what we're looking for. We're not looking for perfection. We're looking for probabilities. And that'll be its own kind of separate stream too. It's a first principle. It's a mental model, but I think you guys get what I'm saying here. Okay. And then, oh, look at that. Randomly, we trade through it. And then, oh, what's happening right here? It becomes an inverted suspension block. Bang. You guys have no idea how much cool stuff you're going to learn over the next few weeks. Like, in all seriousness, you have no idea. Suspension block, respected to go higher. It just can't make a new high. No worries. We trade through it. And then look at that. All of the wicks and the bodies are staying in the lower half. Is Trump speaking right now? Or is that at 1 o'clock? In all honesty, I did not even check Forex Factory today. Today's the 30th, right? Oh, Powell spoke at 9:30. Well, it doesn't say it on here, but I believe you though. Oh, he said something on Twitter. It might even be on Truth Social. That's his like social media app. It might be over there. I don't have I mean I have Twitter open on a separate tab, but that's only because of my tweets, not for Trump or anybody else. But that wouldn't surprise me at all. He's been talking about Iran for the last, I don't know, few weeks or so. So that doesn't surprise me at all. I just feel like we're getting less and less volatility when the more headlines we get. Yeah, Williams, who cares about that guy? No, I'm kidding. I don't care about politics, but I really don't care for like reclaimed concepts, but it is a thing, and I'll at least share it with you so that way you know I'm not hiding anything from you. Like, oh, you talk about reclaim, but you mention it, but you never talk about it. What is it? And I'll end it with this. So, and this is why it's my least favorite, like, inefficiency, or it's my least favorite method of, like, I will not take a trade based on this. I'll read price based on this, but I usually don't trade it. I did one of those last week. That was the ES trade that I fumbled. I fumbled that break even pretty bad. But what is a reclaim? Okay. Sunday's gap. We trade through it, right? We come down to it to offer sell side delivery. Now, I want you to imagine for a second that Sunday's gap gets respected to go higher. Okay, to whatever degree. A reclaimed concept is when it gets respected to go higher. It gets disrespected to take something out. Now, where we are today, March 30th, there's almost nothing to the left on indices. There's really no reference point over there, unless you look at a weekly or a monthly, like way back when. But for sake of argument, we trade lower for whatever reason, liquidity or something, and we get back above Sunday's gap, and then into it, and that becomes, let's say, buying opportunity to go higher. So that revisit, okay, below it, back above it, and into it to go higher, that is what a reclaimed concept is. And that happens with all of it. Imbalances too, those will work as well. But it really just depends on how advanced you want to get, chat. And I think there was something on ES I wanted to talk about, and I didn't write it down. So I feel like that's a good spot to leave it. You guys have any last minute questions before we go over how to read meditations? Do you have any last minute questions on what we talked about today? Imbalances, inversions, gaps. Oh, I didn't give you this. I'll give you this. Why this works so well? And you know what? I'll do this one. Because I think this is what I was meaning to talk about earlier. Why this works so well, and this is basically the same inversion that I showed you on NQ. Why this works so well is because what this is right here is one of the methods, okay, to a shift in the state of delivery or a change in the state of delivery. The verbiage is whatever you want. It doesn't even matter. I say this all the time, that names don't matter. Context does. So you could call this a goober if you'd like. It doesn't matter. But either way, what's taking place here is the market, okay, by reading that at 946 to close, okay, ideally the close, price has now shown you, hey, we refuse to take out that low the way that NQ did. That's a divergence. That's not for like lesson number 6. So if you want more on that, jump to number 6 if it's available. That is one of these shifts in the state of delivery. It's telling you, hey, I refuse to go for that low. I'm under accumulation. That imbalance is not bearish, right? So I get traded through and I get treated the other direction. So I'm not bearish, I am bullish. And so the market, okay, in this case, we had equities open is here. We get almost no movement above equities open. That's going to be its own video as well. But we trade lower and lower and lower and lower. Small retracement here, and then lower again. So around 945, you have to understand that the majority of what's taken place has been lower. That means anybody who is short right now is blessed. Okay? They're blessed because they're in open profit. Now, what happens when you actually learn about trade management is if you're able to catch, 50, 60 point move on ES, right? That's a sizable move. And what happens is traders have their stop loss wherever it may be, and they drag it lower. All right. So what happens is the market is going to come back for trailing stops. And this reached all the way up into the same thing that NQ did. There's inefficiency up here. Okay. So that reversal was an attack on trailing stops. Because remember, and I tweeted about this too, the lows like that, anybody who caught the long going higher, they're going to build stops there. And then, of course, 2 imbalances, take the lower one, trades lower, consolidates, and then bang, runs the lows. So that's what that is. In closing, that's what that is. That's why this stuff works so well. It's a shift in a state of delivery. It's one of the earliest signatures that we have a turn in price. We have turned from, not we, but the market, okay? The market has turned from being bearish into being bullish. And the markets, okay, I don't know what the percentage is, but I'm going to say like 90% of the time or more, the market is going to give you an opportunity before going higher, or it's going to give you an opportunity to short before going lower, because the markets are designed to do this. You'll learn more about that as we go as well. I won't tell you today, but I'll leave you with this. The markets are highly structured, okay? There is a method to the madness, okay? There is order within chaos, okay? And inefficiencies are one of the ways to read it. So when you see that shift, you don't just buy the next candle unless it trades into it. If you miss the boat thinking like, oh, I missed the move. Not yet. You may have not bought that low. Fine. But the next retracement, that could be a long opportunity or a couple candles after that. And I will tell you, for those of you that know, that's 950 right here. That's 950. So if you know, you know. And we run all the way up to about 10:05. So, but yeah, that I feel like is a pretty good stream for today. What do you guys think? It's 1 o'clock, by the way. Did you guys learn something today? One of you did ask about time frame alignment. I didn't mean to ignore your question, but basically, what you need, I'll go over this in later episodes, but what you need is time frame alignment, okay? The two most important time frames are the weekly and the daily. The weekly and the daily, okay? This isn't really part of the lesson anymore, but, you know, we're here, and this is a live stream. There are people here. There's over 50 people here. But a couple weeks ago, I think it was March 8th, I shared this with my students. I don't think I made it public until later on, but I pointed out this low right here from November 21st. And then I also pointed out these lows from August, like July, August of 2025. And I've been tweeting and I've been on Facebook saying, hey, stocks don't look too good, do they? Stocks still don't look good, do they? No, they're massively bearish right now. I've even said that in the market reviews the last couple of weeks too. This is not a good time to buy stocks right now. Why is that? Because, again, based on the higher time frame, we are probably going for these lows. And it's the same thing for the S&P as well. Okay? Friday's stream of last week, a lot of you probably weren't there if you're watching this as a recording. But before we got there, I was like, yeah, that's our next low. And we got that not long after that. And same thing. ES just has this cluster of lows here. That is going to be a higher time frame target. Okay? Especially now because we've taken off. If you remember when we were back in here, and we were here for like months, dude. And you remember I was telling you, we need to leave this consolidation. We need to get out of it and either go to all-time highs, or, you know, if we don't do that, if we leave it, then we're going lower. And you can see the difference now. We moved from consolidation to expansion. And right now, we are in a heavy expansion. We are in a, well, that's what it is. It's a heavy expansion lower. And Ricky, that's actually a really, really good point. The dollar index is also strong. You'll learn more about that in intermarket analysis. That's another video. I think that'll be number 8 or 9. I don't know. But there's a gap here. Definitely a gap here. We have 2 in a row. So we measure this imbalance with those 2 gaps. That is a suspension, or suspension block, if you want to call it that. We traded into that, and now we are seeing an expansion higher. So a higher dollar, right, or a more expensive dollar, the inverse of that is going to be lower currencies, lower foreign currency. And if it aligns, in this case it does, lower indices as well. So think of it like indices are already bearish. They're already bearish based on some of the fundamentals, what's going on in the world right now across the ocean, right? With, you know, you guys know. So fundamentally, stocks are not bullish. Technically, because this is a technical analysis video, and the core concept was inefficiencies, these are levels of liquidity. So fundamentally, it's not bullish, so we're bearish. And technically speaking, we are bearish. And with the dollar index, think of the dollar being like icing on the cake. Yeah, I think I had briefly went over, if you can't see the chat, Ricky made a comment that I was talking about EU and the dollar. I did post something on my Instagram story that was like that. And I think it was in here. And I was saying that with the dollar going higher, foreign currency, or excuse me, with the dollar going lower at the time, foreign currencies would go higher. And they pretty much all did. Euro did, pound did, and all of that. But yeah, the dollar index aligning like that, meaning we're getting a more expensive dollar, we're getting a stronger US dollar, that's going to add to the bearishness of indices. So coming back to the original question, time frame alignment. When you start off on the weekly, you start off on the daily, you get a broader perspective. You go, hey, stocks are not bullish, right? Okay, great. But what does that mean for us? Well, that means I don't just short right at the open like this. I'm not usually the type to do that. But that means we're going to look for inefficiencies as targets. I got to pin that. I got to pin that comment. Ricky said, it's crazy these influencers with like 50,000 plus followers don't even know that information. Right. Exactly. You know, they tweet, oh, price action's bad. It's not price action that's bad. Be professional, John. Be professional. You can see that in this particular case, we traded right here at 1245 right to the upper end of Sunday's gap to trade lower. That's not a coincidence. I told you the stuff was highly controlled and highly technical, and that is one of the signatures. But anyway, guys, we've been here like an hour. I've thrown a lot your way. You learned a lot of things. I actually covered a lot more stuff than I planned on doing that, and I have a habit of that. But it's only because I care about you, man, and I want you to have complete information. I don't like when people teach partial concepts. You know what I mean? Like they'll teach you something, they'll kind of give you a piece, but then you take that piece and you go into markets and you get chopped up. And that's because there's so many more aspects to it than that. You know what I mean? But yeah, it is crazy. We are in crazy times, Ricky. And everybody else, we are in some wild times. But it doesn't mean that price isn't unpredictable. Okay? I talked about the lows on ES. I thought we were going to make a higher high. We failed to do it, and we just dumped down there anyway. So this is a massively bearish market. And look at that. ES. Sorry, this will be the last thing. If you've never watched my stuff before, you know that I do this a lot. I'll say I'm going to close with this, and then I end up doing like 75 more things. And that's just who I am, guys. We all have our own habits, right? See that gap? We got buy side delivery, and we never got sell side delivery. Look what we reached for. A lot of people think equal lows are going to be reversals. Okay. Well, if you bought below those equal lows, you just got wrecked. Why is that? Because of Sunday's gap. Didn't have sell side delivery. I'm trying not to say the A word. That rhymes with, I ain't going to say it. But it starts with an A and ends with an M. Brought the market down here. So that's how this stuff's work. Or that's how this stuff works, excuse me. Price trades from inefficiency to inefficiency. Liquidity to liquidity. Inefficiency to liquidity. And liquidity to inefficiency. That's all it ever does. That's all price ever does is two things. It trades to levels of liquidity, and levels of inefficiency. Levels of inefficiency. So, that'll be it for today. For the technical analysis portion, I'll do this really briefly. Guys, book of the month, if you are following along. Book of the month is the Meditations of Marcus Aurelius. The Meditations of Marcus Aurelius. You can also do the annotated one if you'd like. I actually recommend the annotated one. If you're going to read it, you might as well read it to its entirety, okay? Meaning like our version of wisdom, courage, justice, and temperance might be different from 2,000 years ago, okay? But that's how you should read it. Number one is don't skip the introduction. Read the introduction and the author's note, whatever else is in there, before you get to the first book, which is really just a gratitude practice, which is important. But you need the background information and the context. Number two, don't read it like a book. Meditations is not a book. It's a book to us, sure, because it's words on a page. But you'll notice there's really very few paragraphs. There's almost no paragraphs in here. The opening of book 5, yes, there is. But a lot of this stuff you'll see that? See my camera? Are like 2 or 3 lines at most, maybe a paragraph every once in a while. But these are really more so fragments. That's really more of what they are. They're a couple sentences at most. And that's because this was his journal. This was the journal of the most richest and the most powerful man in Rome in 160s AD. 170 AD. All right? So don't read it like a book because there's no story. You have to take time and think about what he's saying. Number 3, use the lens of the cardinal virtues. So look for themes of wisdom, courage, justice, and temperance. And if you'd like, I lost my pen. Take a pen, okay? Mark up your book. You can write an A for anger, J for justice, W for wisdom, a C for courage, T for temperance, E for ego. That's a big one. I let that slip a lot on here. You'll see that. Moving on. D is for death, and H is for handle or control. Number 4. I went out of order. It's okay. Number 4, read it again next year. Because books don't change, but we do. You guys with me so far? Or have you been with me this whole time? We do not change. We do. Books don't change, okay? But people do. The words in this book haven't changed for 2,000 years. But I am not the same John Phibb from 5 years ago or from 3 years ago. Or since I've been losing weight, I'm not even the same John Fib from 8 weeks ago. I'm like 12 pounds down, dude. I feel phenomenal. We change, okay? And you're going to have a different perspective the second or third time around. The same way that young people care about material stuff. I mean, I know I just bought a Corvette, but young people care about stuff. Old people care about time and family. And that changes throughout your life. You no longer care about the clothes and the cars or whatever. And you eventually start to understand that time is valuable. You know what I mean? And you'll see that shift in your own life. And the last thing, make reading an activity. Okay? Don't be afraid to mark it up, drop it, break it, spill food stains on it. I've got food stains in my books too. It's okay. You can always buy more copies. It's like a $10 book, dude. Don't keep it clean. All right, mine is falling apart at this point. There's actually a stain on the pages right here because the oil from my hand has flipped through the pages so many times that they're yellowed, like a yellowish brown. It's kind of gross, but that's what it is. It's reading actively. So with that, y'all be good. Be blessed. Have an amazing rest of your day. We'll be here same time, same place tomorrow for episode 2 of Core Technical Analysis Concepts. Episode 2 is going to be the open, high, low, close, or the open, low, high, close candle formations, which is all we ever really look at. That's all this stuff is. Every candle is an open, high, low, close. But tomorrow I'm going to teach you how to use that information. How to use it well. So I'll see y'all tomorrow.
can't